Fables of ESOP podcast. As part of Fables of ESOP, we cover regularly the amount of liquidity available to employees and stakeholders in Indian and Southeast Asian startups. Right. So today we are going to deep dive on that. What is liquidity, right? And how can companies and founders offer liquidity to their employees and stakeholders in a structured manner? Right? And to do so, we have Skanda with us today. Skanda is my colleague at Qapita, and he's the CEO of Qapita Marketplace. Qapita Marketplace is enabling liquidity in the private markets, and I'll let him talk about his background and more about this soon. Uh, so, as I have also mentioned in some of the previous newsletters, that the Indian ecosystem has enabled about $450 million worth liquidity to employees and stakeholders, right? So there's no better time to be kind of operating in this space. So now to deep dive into this, Skanda, you've come from a banking background, right? And now you have joined a tech startup, right? So before we actually go into all of this liquidity aspects, why don't you talk about why did you make that switch? You spent 2 decades in a bank, and then now you're looking to come into a tech-led startup. So talk us through your journey and early days at Qapita.
Sure. Thanks, Shrikant, firstly, for having me over and for putting this program together. Yes, this topic is of great interest, but before that, why Qapita for me? As I had spent a couple of decades, through different aspects of banking, most recently as an investment banker, what I had seen is that through the entire cycles of how private market fundraisers and transactions were evolving, we seem to be entering a very interesting phase in the evolution of private market transactions, where I believe that the market is just about starting to mature. And with so much of availability of different pools of capital across the world interested in Asia, specifically India and Southeast Asia, for me, the itch was definitely there to say that, look, how can we, solve this complex problem at scale? And, the way when I say the complex problem at scale, I'm referring to a fundamental lack of financial infrastructure to be able to put through some of these private transactions in play. And I'll explain that as we go along in the talk. But yes, it's good to be here. So thanks for putting this together again.
Wonderful, Skanda. No, thanks for that quick intro as to what interested you. I think building Rails, as we call it, is definitely the need of the hour, and I think we at Qapita seem to be doing that. So let's talk about a few generic aspects about liquidity, right? So for the uninitiated, let's say a founder or a CFO listening in here, what does liquidity mean, right? So what is stakeholder liquidity and why is it important, especially at this juncture of the startups?
Yeah, I think if you look at it from a very first principles standpoint, we are referring to liquidity and stakeholder liquidity and ESOP liquidity in private companies, right? So if you actually had to draw a parallel and if you had to take maybe one step or two steps backwards and understand why do companies go public, and you would have seen that if, let's say, I was an ESOP holder or a stakeholder in a public company, if I, whatever the valuation is, even if I were making a loss as a shareholder, I should be able to, sell that share in the market, and I should at least free up my cash. That effectively is what the desire for liquidity is all about, and that's why people have let's say addressed and have gone to the public markets to create shareholder liquidity apart from actually raising money for their own expansion. But is it the only route possible today? Is it the best option today? Because if you list prematurely, we've seen this before, and we are seeing this in this cycle as well. People who've listed prematurely for the public markets, there is a steep correction that happens, in the stock when the earnings estimates don't meet a certain performance standards, so to speak. Lot more disclosure requirements, lot more reporting requirements, etc. People hitherto used to do that because there was no other choice. But I think today, with the evolution, like I mentioned before, the evolution of private markets being where they are, there is more incentive for private markets to continue to say, or private companies to say, stay private for a longer time rather than only go there. Why? Because there is enough liquidity, enough number of pools of capital willing to do that. So that said, now how to answer your question, sorry, it's a bit of a long-bound answer, but to answer your question on what does it mean when you say stakeholder liquidity or ESOP liquidity, many people are option holders or small shareholders in a private company right? And not necessarily that they always have all the avenues available as some of the larger shareholders, institutional shareholders, from a liquidity perspective, right? So the emerging market or the emerging trend is to try and see how we make those liquidity avenues available, right, for all such shareholders, in a fairly seamless manner, as you would see in the public space.
Right. No, wonderful. I think you kind of nicely elaborated the need for liquidity, right? Now, the next logical question I think founders might to ask is when should one consider conducting a liquidity program, right, for their employees or for their early stakeholders?
Yeah, I think that's a tough question to answer as a generalization. It really depends on the evolution of the company, and it has to be taken on a case-to-case basis. I mean, in the recent past, we have seen people give out liquidity to their shareholders as early as a Series B. But then years back, if you look at it, any liquidity was possible only before a pre-IPO. So the whole idea now is to try and see how this entire continuum of from Series B to pre-IPO and thereafter IPO is filled through different avenues of liquidity, and it doesn't have to be like one big bang event, right? I mean, I think clearly what we're seeing as a trend is that there is a clear need for more structured and frequent liquidity events, right? So irrespective of where you are as a company or as a founder, if let us say there is a certain liquidity event that has been missed now, it's like I said before, the private markets are a lot more liquid than people give it credit for. So the window is not fully passed on. So 6 months down the line or 9 months down the line, you can always conduct a structured liquidity event for us for meaningful liquidity to be done.
Correct. I mean, we are also hearing anytime liquidity or everyday liquidity these days. So there
That's
are
right.
also companies going to the other end of the spectrum and offering liquidity just like public markets. But now coming next to now that we kind of gave some insights on when to conduct, the $1 million question is how does liquidity get financed? Because at the end of the day, somebody has to take the bill, right? In that sense. So how does structurally, what are the different possibilities that founders can offer?
Yeah. So I think that answer would depend on liquidity for whom, right? So I think, is it for the option holders or is it for the shareholders?
So when you say option holders, ESOP holders.
ESOP holders, sorry. So either you're an employee and an ESOP holder, and the founder is trying to give liquidity to a bunch of such ESOP holders, or there are a few shareholders who are on the cap table who the founder may want to give liquidity for. Now, traditionally, what has happened is, or at least you mentioned earlier that about 50 odd companies or $450 million of liquidity has been passed on.
Right.
Most of that has come through what is called an ESOP surrender program. Okay. Wherein what people do is, if let us say I am an ESOP holder, I go to my company and actually say that, look, I have, let's say, 100 options. I know 10 of them are eligible for this round of liquidity. So I will surrender the 10 options. I will still hold on to 90. And these options, mind you, ESOPs are not converted to shares just yet.
Right.
So they have vested fully, and they can be converted at any point in time, but for liquidity constraints or whatever they may be, I have not converted them into shares, right? So therefore what I would need to do is to waive my right or surrender my rights on the 10 options which I need to liquidate and get liquidity for, right? So I go to the company comes and says, okay, look, Skanda, you're eligible for some amount of liquidity, which means that you will have to surrender some of your options. And then I give out a consent, saying that, yes, I understand this is what it is. And the financing happens where the company gives that to me, as the way it will reflect on this thing, it will be like an income, special income coming my way as a one-time event.
Understood.
Right? But in lieu of surrendered options.
So when people colloquially just say buyback, it's not really a buyback. You're basically surrendering your options and you're getting income in lieu of the value appreciation.
That is right. Buyback is generally a term used when you are buying back shares from the treasury stock of the company. In India, you're not allowed to hold treasury stock, but so you extinguish shares, which is a bit of a technical point.
Right.
But generally, buyback means that the company, using its balance sheet, will actually buy back shares from shareholders, be it employee shareholders or other stakeholders, and it will extinguish those stocks. So it's a slightly different kind of a process, right? And it has different tax implications, it has different company law implications, etc. Here we're talking about the ESOP surrender options, where like I said, 100 options. I have all of them vested. I have not converted them into shares, and it's just at my choice that I can convert them anytime.
Right.
And before I could convert them, the the employer is offering me liquidity.
Right.
And I say, okay, the best way for me to do it is to, let's say, surrender part of those options, and I get money in lieu of the surrender.
Understood.
And so it will be income on my statement.
Got it. So I think three broad areas. So one is buyback of options. There can also be our surrender of options.
Yeah.
Technically, being right there.
Right.
Then buyback of shares.
Right.
And then recently we're also seeing secondary share transfer as well, right?
Yes,
so,
absolutely. That's like any other share transfer, right? So
Right.
you see so many transactions happen in the private space, and there are two kinds of transactions: either money coming into the company,
Right.
or money coming into the hands of a shareholder.
Right.
So wherever money comes into the hands of a shareholder, it's called a secondary trade.
Right.
So once, let's say, whether it is an employee who's converted his ESOPs into shares, or if it's an angel investor or a VC investor holding those shares,
Right.
and when those shares get purchased by a third party,
Right.
then that's called a secondary transfer. And the standard process for the secondary transfer will apply in those cases. There are a few examples in the recent liquidity history where some of the ESOPs have been striped, which means converted into shares, and they have been transferred. But by and large, like I said, most of the liquidity has happened from ESOP surrender as a process.
Got it. So wonderful. I think moving on with this life cycle. So can you also mentioned earlier in your in the conversation that it's quite cumbersome for these programs to happen in private markets. That's the difference between public and private. At public, I buy or sell, and tomorrow my shares are there in a demat account. But it's a much more cumbersome process for a private company.
That's
so
right.
Can you elaborate the process involved in all of these programs you mentioned?
Yeah, that's what I was referring to when I said the infrastructure is broken.
Okay.
So, just to double click on that point you mentioned. So if I had to buy, let us say, 10 shares of Infosys today, or any other listed company, I just log on to the screen and actually place an order. And by evening, I have the the share sitting in my demat account. In a private transaction, let's assume that a buyer is found, a seller is found, and the price has been agreed to. It takes few weeks to put that trade together. Why? Because by definition, private companies means the shareholding has to be private, and it can't be a free float instrument that can be out there in the market.
Right.
So what does that mean, right? So it means that pretty much every single transfer, no matter how small or how big, has to be in compliance with many things. It has to be in compliance with the company law. It has to be in compliance with, let us say, FEMA, depending on whether the buyer or seller is a resident Indian or a non-resident Indian. There are a bunch of investor rights for preference shareholders, and mostly institutional shareholders who are, let's say, sitting on the cap table, will have the right to have the first right to buy whatever shares are on offer.
Right.
So it's not one of those class of instruments which can be freely traded like how you can do in the public markets. And so by the time you cross all those hoops and you actually get everything together, it can take anywhere between 4 to 6 weeks. It doesn't have to,
Right.
and that is exactly the problem that we're trying to address here and try to solve by creating more digital infrastructure around it. But the fact is, it does take as much time.
That much time and that much process. So that seems to be a long ordeal, and we'll come to how we are going to disrupt it. But maybe before that, would you maybe just to complete this discussion, what are the recent trends you are seeing with regard to ESOP liquidity or stakeholder liquidity? You did mention that it's becoming much better.
Yeah.
So do you want to elaborate further on that in terms of some of the trends that you're seeing and what possibly can come in the future?
Yeah. See, look, apart from just the absolute, I would say, bursting out of the entrepreneurial scene in this region,
Right.
And more people becoming entrepreneurs or joining startups. One trend which is also very cultural in nature, even as an employee, right? So I think if you were to rewind, let's say 2 decades back or 3 decades back, our parents' generation would basically be government employees, and they'd be very, very happy doing one job for like so many years. And then when we started working, we said, okay, government is not going to cut eyes. We want to be in a private company where fixed salary and bonus was the trend.
Right.
Now the entire generation has moved to it, saying that look, they don't find employment opportunities which do not give ESOP,
Right.
and therefore ESOP liquidity. If they don't have the skin in the game or any outlet for that skin in the game, it's not an attractive employment opportunity. So the trend, I don't think, should be read only as a fad which is going to go away once the markets correct.
Right.
Because the markets may correct, valuations may come down, the purse size may shrink. But what is I think a structural shift is in the way employees have started to look at employment, let alone entrepreneurs wanting to start off. So people want skin in the game, and people want that money towards the skin in the game.
Wonderful. I think skin in the game is the new buzzword, and I think youngsters want to retire at 35 these days. So what I mean, obviously ESOPs are ones that enable them to do so, I guess.
Yeah, I guess that's the only way. Yeah,
that's right.
Yeah.
So just coming to now talking about some of the, you also mentioned that ESOPs can also happen through secondary sale and some of these opportunities, right, where there's external liquidity outside of the companies also that can be deployed to provide liquidity, right? So, and what is your thought here? Like there is obviously this funding winter, so-called, right, and maybe companies are looking at conserving their balance sheets and extending their runways and so on and so forth. So what do you see playing out? And another thing we also discussed prior to this was also this whole new age HNIs and investors who all are wanting to invest in startups, so others will. So how do you want to weave all of these realities in the coming future?
Yeah, so I think, look, there are some structural elements and there are some elements which are very cyclical and timing linked. I think you're right that we are going through a tough period, and I think this tough period is going to last for a bit. Right. Where the macros are not going to support for a very, very vibrant and a liquid public or private market, so to speak. But but if you actually put things in perspective, and if you ask yourself a very different question, remove 2020, 2021 off the charts, because those were clearly outliers on both extremes, right? But if you look at and compare the funding that is happening now compared to 2019, it's not such a bad scene, right? And the fundamentals have really not changed. And most importantly, if you look at the global pools of capital, which you just mentioned, about $1 trillion or so were harvested out of private investments back in 2019, and that has to get repooled, right, into private investments globally, not just India, right? And if you, even within India and Southeast Asia, you look at some of the recent announcements from Sequoia, Axel, Lightspeed, absolutely. So many of these funds who actually raised the money, they have to get deployed. So I'm not worried about the recent cycle with the structural shift on how capital is going to move.
Wonderful. So liquidity is here to stay, and and there are these new pools of liquidity that are being discovered, and I guess they can be also deployed, which I think.
Absolutely, I think it's part of everybody's allocation these days. We've got retail investors investing in private, opportunities for the first time in the last cycle. I think they've seen alpha returns like never before. I don't think that once you've seen it, you're going to be able to do it with it. Maybe risk covers for the time being, but then I think they will come back.
Wonderful. So now let's to end the discussion, let's talk about Qapita Marketplace, right? We just launched Qapita Marketplace. I think there's a lot of work happening, also bringing a lot of products here. So would you want to talk about our approach at Qapita to bring this liquidity for various stakeholders in this equation?
Yeah. No, so actually, look, like I said before, we are trying to build the rails for a broken financial infrastructure play, right? I think that's our prime focus. We want to make deal making smooth. We want to make, once a buyer, seller, and let us say a price has been agreed to, the 4 to 6 weeks timelines that I alluded to, there's no reason for it to be there. That is one part of what we're trying to do, is to actually bring that process down. The second part of it obviously is to bring and channel different pools of capital available for different, pools of secondary sale available, which is already happening in the market. It's just happening through a very different offline process. We're trying to bring a very digital manner in which a lot of those secondary trades can be put together. Over and above which, I think for private companies, because they will need a consolidation of shareholdings, right? They will need consolidation of the number of shareholders who are there on the cap table. I think we also offer custodial services for that. And most importantly, since we started off with the ESOP liquidity program, is structured liquidity programs for the employees to say that, look, why should you wait for the next round of fundraise or which can happen in a year or two? Why don't you just create a liquidity window every 6 months, irrespective, and we'll build a book around it, and we'll keep providing a window for that liquidity over a period of time.
Wonderful. I think that sounds super exciting. So if you're a startup, you're a founder looking to offer liquidity to your employees, right? And like Skanda mentioned, you could perhaps offer it every 6 months, right? So like your employees will have a chance to surrender their options or sell their shares through a structured liquidity program, right? So if you are intending to do that, you know whom to reach. We'll definitely share more details and coordinates that you can reach out to. But Skanda, this was a super insightful discussion, I would say. Like, I think you deconstructed every bit of this whole process, which otherwise we keep interchangeably hearing, okay, liquidity or buyback, things like that. I think we got a very good sense of what each of these mean and who are all the stakeholders right now active in the ecosystem, right? So yeah, I think we will definitely. I think our audience will hear more about our marketplace and the offerings that you just alluded to as we kind of go along further. So with that, thanks Skanda for anything you would like to add towards
No, nothing at all. Thank you, Shrikant. Thanks for this opportunity. I enjoyed this interaction.
Thanks a lot for spending time with us today, and we'll get back to you soon with more episodes of Fables of ESOP. Thank you.